I think that really is what motivated me to find good partner, is as someone who has that similar interests, similar motivations, similar engagement, but at the same time, they see the glass half full.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor!
Now, here's your host, Dr. Alex Schlo.
Physicians and Properties Podcast. Today, we are talking to someone who represents where many of our listeners are today. Dr. Kathir Balakumaran is a practicing cardiologist in Cleveland, Ohio. He only caught the real estate investing bug in 2024, but in a relatively short period of time, he's built an impressive portfolio of duplexes using the BRRRR strategy. He's converted a previous home into a rental, and he's even begun investing passively in syndications, all while practicing as a full-time cardiologist. What I love about Kathir's story is that it reminds us that you do not have to wait until you know everything. You just have to simply take the first step and get started. Kathir, thank you so much for joining us on the podcast today. How are things going?
Great. Thanks, Alex, for talking to me. Yeah, and this is great. It's an honor to be on this podcast.
Oh, thank you so much. So it's an honor to have you here, and it's been great getting to know you, and I'm excited to share your journey. So let's start at the beginning, the journey into medicine. Why did you get into medicine? Why cardiology, and what did that path look like for you?
Yeah, sure. So I'm a Canadian, and initially the Canadian system had limited spots in their medical school. So I went to the Caribbean, and from there I came to the U.S. In internal medicine at Cleveland, Ohio, and then doing my internal medicine residency, finishing up, I was kind of split between nephrology and cardiology. And then within a short period of time, realizing that as a Canadian, I didn't have any credit, so I couldn't find a lot of places to rent. So after going into like a Section 8 housing, initially as my initial rent option, there's just a lot of problems there. And then after that, I actually bought my first home in my second year of residency, just out of desperation, knowing that I did not want to rent again. So fortunately, I was able to then live there with my now wife. And then I went to Connecticut for a short stint for cardiology. And I think the reason why for me was really an option was just because of the options of how many different avenues you can take. There was so much flexibility with it. So yeah, that was why I chose cardiology. So I practiced for almost 5 years now. I actually went back into training just because of that increasing specialties flexibility.
Yeah, that is awesome. Yeah, and you're doing cardiac diagnostic imagery, it sounds like, for your fellowship,
Yep.
which is incredible. Kind of funny to think about the nephrology versus cardiology, because I feel like that's always the battle in the ICU: cardiology versus nephrology, more LASIK, less LASIK, et cetera. And so it's kind of funny. But it sounds like that specialization and having the opportunity to further grow and expand professionally in cardiology just had more opportunity for you from that perspective and led you down that path.
Absolutely. And I think also the job market at the time, when I looked between nephrology and cardiology, there's just the specialty of the amount of jobs that were available, the amount of places that were hiring. It was just a higher demand for cardiology at the time.
Absolutely. What's been the most rewarding part of practicing cardiology for you?
The patients, I mean, I think the relationships you form, especially I initially did some specialty training in heart failure, and these patients become like lifelong. And so those relationships are really the ones that stick with us.
That's so cool. And I do think that's kind of something that can be a bit more unique in cardiology, to have those lifelong patients that you don't typically get in some other specialties, especially surgical. So that is really cool. And was there a time during fellowship or residency or early in practice where you really started to think more about your financial future and what that would look like for you?
Yeah, I think for me, it was when I left to Connecticut. I had to think about what to do with the house. And that whole aspect, initially I tried to do what we call the house hacking, where, you live in it, but you rent the basement. So I basically rented out the house initially for that. And that kind of brought me out to like the whole concept of, okay, maybe there's some money to be earned with this kind of real estate aspect. So coming back to Cleveland after my stint in Connecticut really initiated this thought process. I think within 2022, 23 really was where the bug started hitting, I would say, looking at like podcasts and looking at reading books and actually seeing what else was out there. That was really when I think it all started.
That's awesome. Were there any specific resources that were really helpful for you when you were just getting started, learning more about investing in real estate?
Yeah, I would say as many things you could digest. Like for me, so Car Rides was a podcast, your podcast. There was another podcast. I don't know, I can't see that anymore, but it was like another physician and real estate podcast. There was also a lot of books. One first book that I started reading was How to Build Wealth One House at a Time. That really,
it's a good one.
Yeah, that's really what triggered me. Then there's like the, Rich Dad, Poor Dad, every kind of the typical kind of concepts of passive, having other assets kind of build. Those are really the different avenues. I think I also read this other book that was looking at, it was more like a real estate for physicians. It was all about syndications. So anything that came over, I just absorbed it. Yeah. Even wholesale. I remember I read books about wholesaling. Like I really got into it to a point where I remember joining a course and it's like to understand what wholesaling was. And just when I looked at that, then I remember actually going through the scripts and calling people as a physician. I'm like, I was calling, cold calling, and I'm like, maybe I'm not wanting to do this portion of it. But then I remember meeting wholesalers and then seeing off-market deals through these wholesalers that I met. It really was, there was all these little resources that were all these little steps along the way that were like little tidbits of information that made me realize, okay, do I want to do passive, which, obviously, like the syndications type, or do you want to do more active? And that made me realize what kind of avenue I wanted to go in.
Yeah, that's a great point. And I think, as you mentioned, like having that education, being willing to like spend a little bit of money to get that course was probably helpful to understand, like, maybe you didn't make money wholesaling and that's totally fine, but you understood, hey, man, wholesaling's not for me, necessarily, but you still learned a lot of tips and tricks that were helpful in your real estate journey, which we'll get to here in a sec. I wanted to ask, do you think that your situation with like the Section 8 housing and having to rent that, and then the understanding like, hey, I just need to buy a house sooner rather than later. Do you think that situation kind of helped to keep you from like the lifestyle creep that happens when we go from residency to attending, or was that something that you struggled with? No.
So I think I would have lived in that house still. So it was a great house. For me and my wife, it was a girlfriend at the time. It was more than enough room. We could have easily lived there, and then the 2 kids came, and that really made us want to upsize it within the last 3 years. So that house itself easily was, especially in the Cleveland area. I remember I bought it for $85,000, which gave me a mortgage of like $600 to $800 a month.
Yeah.
And I was paying that same into being an attending. So that definitely allowed us to save a lot of money and utilize that money for different avenues.
Yeah, it's so huge to delay that lifestyle creep if you can. And it's hard. I mean, obviously your residency and your training is way longer than family medicine, but it is hard because you get to the end and you get that attending paycheck and you feel like, oh man, I deserve this, right? But like if you can push off even just a couple of years of like, hey, I'm going to keep living on that resident salary and save the difference of residency and attending salary, that can be such a big like nest egg to get started in investing that can really change the game and get you to some form of financial freedom a lot faster. So that's really cool to hear that you were able to do that.
Yeah, I think the biggest thing that were, once my wife, she's a U.S. grad, and you as a U.S. grad, I see it. Loans are big, so she was a $480,000 in debt.
Wow.
Which, at the end of the day, like our monies come together. So her debt's my debt, and we were able to pay all that off, thankfully. because of that delayed, I would say, gratification, that we had the housing, we were well comfortable within our means. And I think that's really our motivation, was to take care of all that before our next stage of life.
That's amazing. It's such a huge, weight probably that came off you guys once that was paid off, especially, starting to have young kids as well. And just to not have that debt burden hanging over your heads, I'm sure was huge for you. So that's fantastic. Congratulations on doing that, because that's no easy feat, regardless of income.
Right. And I think, mind you, we with the intention to pay everything off. I think she did her 10 years loan forgiveness. So we had basically accumulated everything just in case that 10 years didn't work out. So we had everything paid off in the sense that everything was ready to pay it off. Then she gets the 10 years loan forgiveness. So now we have this nest egg to play with. So that's what really ended up happening.
That's awesome. That is awesome. So it sounds like real estate really started to get on your radar when you were in Connecticut, moved back to Cleveland. You had the house hack initially, and that kind of got the wheels turning on, hey, I can generate some income. What did it look like as you started to get further into your real estate investing journey?
Yeah. So initially, after the first house, we basically when we moved, I basically rented that out. So I rented that whole house, and then we had, then it really came to the point where I remember looking for different houses, but really nothing came about until I met, now a really good friend at one of our children's parties. And, just kind of came in that he works for DoorDash. His name is Eric Quant. He's my best friend, hands down now. And we just had this mutual interest. And I just remember one day, it's like, hey, it was like several months later in our relation, like literally we were like, hey, do you want to buy a house? I got this idea, you're really good with sales and calling people and getting things done. And, I have some experience doing this as well. So why don't we just join forces? And then we also combined it with one of my other doctor friends, who's now just the capital portion of it. And that really, those pieces all came together nicely, and that just escalated the journey. So what we did was basically we bought a kind of a distressed property. And in the beginning, we really put a lot of sweat equity into it. And that really gave us the skill set of understanding what the costs would be when the next set of housing needs, we didn't get swindled, in essence. We found a good plumber, we found the good contractor, we found a good electrician, we found all the good people just because of all the time and sweat equity we had to do to understand what it takes to, for instance, a toilet. If your toilet breaks, we know that there's this company that's going to come in and charge you $400 just to take your toilet off and put it back on. Whereas that in itself is a job that someone else was saying, hey, dude, that's not that expensive. Here's 100. You just give me 150. I'll take care of that. So that really gave us an understanding of how much money we could allocate for each of these different things. And once we figured out that with the first house, we just kind of rinsed and repeated. And now we have a system in place that allows us to make sure we get duplexes, because duplexes, I would say, especially in the Cleveland area, are a hidden asset. You have a property that pretty much has two doors. If you have one already occupied, great. And that person is paying off the mortgage, in essence, and maybe even a little bit more, just because of the rent to price ratio is so low. Sorry, I should say so high. I apologize. It's so high.
Yeah.
And then once you remodel the bottom unit, you pretty much have this increased amount of cash flow that we now within, I think the last probably we just refinanced within, I think like 9 months to 12 months. And we were able to take that money out and put it to the next property.
That's awesome.
It really does help in the sense of finding that nice unit, taking your time, and the areas, really researching areas. Like I remember doing, I'm sorry, I'm probably talking a lot, but
no, this is great. Keep going. Yeah.
Sure. But I remember researching based on maps of like what areas to focus on, and really understanding the zip codes, looking at the different prices of the real estate, looking at the rents, looking at the number of places that foreclose, looking at the pieces, there's all these different data points you can look at. And a lot of these are even public record. Like you can see based on eviction records, you can see what areas or zip codes have the most amount of evictions. So you already know, okay, this is probably the zip code I'm going to avoid because it's all public record. And so that really helped I think I did that for almost a year. I just did research just to make sure, because I'm very risk averse. I don't like the whole, let me take $1 million loan out and develop 300 houses and hopefully they also, I'm not that kind of person. I'm very much, let me slow go and make sure I do this right. Let me get it down to the itty bitty numbers and make sure the asset can take care of this. So I'm not counting anywhere in the red during this holding period. And that's really what I think was a formula for me that worked out. And I've been very fortunate enough to be able to do that without saying, hey, can you throw more capital in this? Oh, this happened or this happened. So it's been good that way.
That is awesome. I want to hit on a few things that you mentioned. One, I'd love to talk about partnerships because that's something that's really, really important and can either really help you take off with your portfolio or can be difficult. So I want to talk about that if you don't mind. Well, and the BRRRR strategy for sure. But I wanted to hit on something that you just mentioned. I think you've done a good job risk mitigating in a couple of different ways, obviously really underwriting conservatively, but all the due diligence that you've done to make sure like, hey, this is the right neighborhood I want to be in. We've really dialed down the cost. We're doing duplexes, so we know like, hey, at least if one's rented out, we're meeting our mortgage payments, and those sorts of things are great risk mitigators. And over time, I'm sure you've been really able to dial those numbers down a lot more to the point where you probably are like, hey, I can really quickly now analyze properties and we can make good decisions. And so for folks who are listening to this, like you mentioned, you were doing that for a year. You were trying to figure out, hey, where are the right neighborhoods? Where are the right properties? What's the right cost? What's the right rent to price ratio? All those sorts of things. So it does take work to do that, but then it gets so much faster after you start doing it and you start taking action. So I wanted to make sure we hit that. Let's talk about partnerships for a second, because when I was listening to you describe the partnership that you have, you mentioned something that I think is really important. All three of you each have different working geniuses or different strong suits in the partnership. And I think that's really, really important because it can be very tempting to be like, oh, I'm just going to partner with my best friend because we're best friends and we'll make it work. But if you both are really good at one thing, but terrible at some of the other avenues, it makes it really, really hard for a partnership to work out. So what has been helpful for you from a partnership perspective in terms of one, figuring out, hey, is this going to be a good partnership? And then two, roles and responsibilities and so forth to keep that running?
No, that's a great question. This is going to sound weird, but, meeting people as you get older and being friends is a little harder. So I think
not weird at all.
Yeah, right. Yeah. So, once it came to a point where we were able to like hang out a couple more times, and then we realized we had similar interests. And I saw his motivations being much more like he was so hyped up and I was just as hyped. The engagement of it, just talking about it and kind of that really spread to the point where like, hey, let's just try this out. And, Raj is our third partner and he's had the experience. And I met him at a wedding. I knew him before during training. He was a fellow when I was a resident, and we just happened to meet at a wedding, and he told me about his experience. And so he was more like a kind of like a mentor in that sense, because he's already gone through it all. But he provided that kind of guidance occasionally whenever we needed help, plus some capital. So that's, I think the way the puzzle pieces came through is that I knew that I needed someone to kind of share in that motivation. Yeah. So what came down to is finding those puzzle pieces that fit. So with Raj, he had the mentorship plus the capital and the experience. And then with Eric, he really had the similar ideas and similar energy and motivation. And what really helped me was there were times where I just needed to bounce ideas off of someone. And he was there. Like he just easily would say, okay, no, we should do this. Maybe you should do that. But on top of that, he would be like the motivator. Like, let's say there were times where I remember the first house, we had all the sweat equity. We would go in and be like, oh, we got to remodel this washroom, or we got to do this flooring. Now there's this giant hole in the floor because there's all these little things that happen during that house, but it was all learning experience. And because the fact that he's like, oh, don't worry, man, this is fine. Yeah, don't worry. At the end of this, you'll see it's great. And I think that really is what motivated me to find good partner, is as someone who has that similar interests, similar motivations, similar engagement, but at the same time, they see the glass half full. Like the times I remember, and I think this is going to happen no matter what. I knew that I was going to eventually go through an eviction. It's inevitable, right? You can't sometimes control for every asset and factor. So when we were going through this eviction, I remember I would be calling him like, man, this sucks. I don't know if I want to do this anymore. And he really just kept it positive. Like, listen, at the end of this, you're fine. And I think without that energy, I don't know if I would have been like, okay, this is for me. I think there's going to be hurdles and obstacles, but I think finding a partner, and it could be your wife. I mean, for me, I know my wife had no interest in any of this. Like, she just said, hey, yeah, go ahead and do it. But there would be like, so that's where that came in, finding that good partner.
Yeah, that's huge. And it can make such a huge difference, especially, I'm really blessed to have some great partners. And also, practicing full-time medicine is a lot of work as well, and taxing and draining, and having another partner or two that can help share that load and those responsibilities can help you grow and scale so much faster, right? Yeah. So that can be huge. I think partnerships, when utilized well, can be such a huge accelerant to your growth and help things move so much faster. And it's just a lot more fun, like doing it with partners and sharing life together and going after the mission together. It's just, it's fantastic. So yeah, I did want to make sure that we hit on that. Well, so I know BRRRRing is a big part of your strategy, or BRRRR investing. Do you mind sharing why that's so appealing to you, and kind of what BRRRRing is for folks who don't understand what the BRRRR strategy is?
Yeah. So basically, BRRRR stands for buy, rehab, rent, refinance, and repeat, and that's it, in that kind of formula. So what we do typically when I was first investigating the BRRRR strategy, I was looking at hard money lenders, hard money loans, all that stuff. But like I said, I'm a very risk adverse individual, so I don't really want to use other people's money. Especially on the interest rates or double digits, the holding, all that. I didn't feel comfortable doing that. So what we do is we basically just take the capital and we put it down, and then we just and what we did was a lot of the rehab it equates to around 20,000 plus the property itself. So we're looking at probably anywhere from 45 to 60,000 initial property. Mm-hmm. And so we put that in, then we rented it out. And within a quick period of time, we were able to refinance at least and take that money out and put it towards the next property. And then we kind of just repeat this within our own capital. If you did other people's capital, I'm sure you could escalate this faster, but we just did it this way. And we focused on duplexes because of the way I liked it, where the mortgage is already being paid off. And then again, the rent to price ratio is so high here in this area that I think it's only possible, at least for me, because I was looking also at, I'm Canadian, so I was looking at Canadian real estate in Toronto, and it's not doable. Like I see my cousins, they own properties there, but no cash flow. It's all just, raising on their principal. In essence, they're just looking at, and in that sense. So for here, though, I like the fact that we're able to increase the price year after year, but also cash flow very high.
U.S. markets are great for that. Cleveland certainly being one of them. It's a great opportunity for cash flow, and you get all the benefits of real estate investing. And BRRRRing is such a great way to, as you mentioned, recycle your capital quickly and really keep that velocity of money going. So you're not having to, sink money in, down payments, renovations on each and every property, because you'll run out of money. That way you can just recycle and repeat and go from there. And so that's a really great way to do it. What have, if you don't mind sharing, what's been, either the biggest mistake that you've had in investing, or not even mistake, but a learning opportunity, as we like to say in medicine? What's been the best learning opportunity that you've had?
Yeah. So I think one of the things that we did initially when we first found tenants is we used a realtor to help screen our tenants through background checks and all that. But I think we put too much trust in that kind of system that was professional. And that's how we ended up having someone who eventually was a serial evictor, not really knowing that there were so many different avenues of background checks. So I think understanding that, I'm a person that does research, but in that moment I put too much trust and didn't do the research. I think always do the research, even on little tiny aspects of it, knowing what you're getting yourself into so that you always have the tools needed to double check. So that's what we do. I do, especially now, is if I do outsource it, it's because I know what it's going to cost. I know what the value of that is to outsource.
That's good.
Yeah.
Yeah. Trust, but verify for sure.
Exactly.
What's
just like medicine.
100%. Yeah. 100%. What about the biggest win?
Yeah. The biggest win is, taxes are a big win. 100%. That is a big win. And then the concept of refinancing, I think, is underappreciated. The interest rates in this market are high, but I think if you are able to time the refinancing appropriately and keep your outgoing costs at a minimum, that there's still a good margin that you can continue building. Maybe not as fast as, let's say, when it was at 2%, but you still are climbing up.
Yeah. And just take it, having just taking action, getting started.
Oh yeah, no,
is so important, right?
You're right. Yeah. And if you would say it that way, I would say yes. Actually pulling the trigger and just buying and putting your number, your signature on the paper and just doing all that process. I think that was the biggest win because it really set the tone of, okay, we have a strategy. Let's keep going.
Yeah, and it's true. And a lot of folks, I feel like now are a little bit more hesitant because the interest rate, they're like, oh, well, I'll just keep waiting, right? The interest rate's going to go down. The interest rate's going to go down. Yes. Well, it's been 5-6 years and the interest rate really hasn't gone down that much. It's slowly downtrending, but I think we're still at 6%, right? Mm-hmm. Like I don't know, who knows if we'll ever get down to 2 or sub 2%, probably not. And so you could end up just be waiting forever for an interest rate. And it's like, well, there's a lot of other factors that go into still making it a good deal. Could you sell or finance it? Could you charge more for the rent? Like there's so many different factors that like, don't let that hold you up. And I agree with you on just getting started. And if you do it well and you think through and you like mitigate risk, right? Like if you're buying, say you're going back in time and you're buying an $85,000 property in Cleveland and your mortgage on that is $800, I'm just using this as an example. Like, what do you really have to be afraid of? Like if everything goes south and you're a cardiologist, you could probably moonlight a shift and pay for the month of cost, right? So it's like just getting started is so important. And I would just encourage folks to think through it in that lens of like, all right, worst case scenario, what would happen? Well, I'd have to like moonlight a shift if I really, in reality, you probably don't even need to do that, but just something to think through from that perspective. If you had to start today with 0 properties, you're just now getting started, is there anything you would do differently or would you still have the same strategy?
I think what I would do differently, let me think. I'm actually very content with the strategy we're doing. I think if there was something I could change, it would obviously be the interest rate. But if it was more or less the same, I would say, I would say look at more houses more frequently is what I would do now. More active, so I can find that instead of buying just like 2 to 3 properties a year, I'd try to scale it more faster.
Okay.
And then finding a property management earlier. I think that's another strategy. One of the things that I didn't do early on, it was the finding the property manager, again, to keep the cost down.
Yeah.
And so what we ended up doing is vetting different PMs and I found one now that's been excellent. But I think if she was always there, I probably would have used her much earlier, kind of thing. Yeah.
That's great advice. Do you think you would have started with a single family home, or would you have jumped right to small multifamily if you had started over?
I think in this market, it depends on where it is. The single, my only concern with single family homes, and I remember talking to my partner about this, is like I'm probably taking, because I remember, that's where I started. I bought a single family home in residency. Am I taking a single family home away from someone else? But the duplex is a little different. It's meant for rentals, So I don't like it. That's why we stick with duplexes, because that's what they're for.
Yeah, absolutely. Well, and it's a great way to think about it that way too, and offers a little bit more flexibility and risk mitigation, as you hit on. Certainly having multiple doors under one roof mitigates that risk as well. So that is awesome. Why do you think physicians overcomplicate just getting started?
I think it's fear. So I think failure, we don't like failure. We like to succeed. We don't like risks. And I'm just talking from a personal experience. I think the fear of failure, it was a big thing that held me back because of the unknown, and that's why I had to do a year of research and just to make sure everything was rightfully in place. I think that's what it is.
Do you think, and I've been thinking about this a lot recently in my own journey, do you think that it is a fear of failure, or do you think it is a fear of people thinking that you failed, if that makes sense?
Yeah, I think,
for me, I've been thinking about that more. I think it's more fear of the perception of failure than actually failing. Because I think one, I'm not going to fail, but also if I did, I'm just going to pull myself up by my bootstraps and get started again and get after it. What are your thoughts on that?
Yeah. No, I think you're right. I think it's that fear of the perception, how do you deal with it? Yeah. I think that's a very well put way to think about this, is that it's not the fear of failure, it's the fear of how do you deal with that failure. In hindsight, that's probably what it was for me.
Maybe. Let me know when you figure that out. That'd be awesome for that perspective. Yeah, well, that's great. Well, I know you have pivoted to also do some passive investing and some syndications.
Yes.
What has that been like for you? What have you liked comparing more active investing to more passive investing? How do you feel like those complement each other?
Yeah. So I think, for me, like I said, I try to get into every avenue. So the wholesaling, the active, passive. I love the active aspect of it, but the passive allows me to take any additional income and just let it work for me. Mm-hmm. So that's what the passive has been. And so syndications, as you know, are basically real estate deals in which multiple people pool their money together, and then the GP or the person basically organizing the deal, or the group. There's limited partners, which we are as the contributors, and then there's the senior partner or the main partner, the general partner. Mm-hmm. They're the ones who organize, and so they will give you distributions on a quarterly basis after a certain period of holding. So we get quarterly distributions, and at the end of our 5-year hold, we'll get a payout that equates to around 25%. And we found this syndication because of one of the books I read was authored by a doctor who did syndications. And so that's how I connected. And it's been, it's still not been the full 5 years, so I can't say what the payout, how it's been, but sometimes I think I've forgotten about it, and then there's a quarterly payment that comes in. I'm like, oh, hey, I forgot about that. So I think when the 5-year payout does come, I'm like, oh, hey, look at that. There's a big sum of money that just came into our bank account. So yeah. I think that's just kind of the niceness of that aspect of this delayed gratification from that.
Yeah, you're absolutely right. And I think, having that passivity is really helpful, especially full-time physician working really hard. You're like, hey, maybe someone listening to this, I don't have the time to renovate a duplex, but passively investing could be a really great way to get started. There's certainly a risk to that. And your returns are probably better overall, more actively investing, but you're trading time, for money and returns, and you have to figure out what works best. But yeah, I was thinking about that too, because I'm in a few syndications, and probably about a year out from some of those, exiting. And same thing. I forgot about that money. And I'm like, oh, this would be really great to get this back and then just recycle and do it again. But yeah, it's a great way to do it. Do you see yourself eventually doing more passive investing, or do you think you're going to continue, working on the duplexes and the BRRRR strategy long term? What are you thinking there?
I was saying to Eric, when we were doing some work on that property, it's like, hey, if you couldn't do medicine, what would you have done? And I'm like, dude, I think we're doing it right now. Like so I'm like, this is, that's what I was telling him. Like, I think I love doing this, the active aspect of getting your heads dirty. And so there's always going to be an active component for me. I always say the skill set that we learn and that we acquired from doing all that has translated to our wives being happier, because now we're, able to do all this stuff in our own house. So I think there's just been so many benefits of this entire journey. 100% I would still stay with active.
That's awesome. I love that. Yeah, I feel the same way. I'm just a builder and kind of like the visionary side. It's like, I'm going to be doing this until I die, because it's just so much fun. And just being able to get involved in real estate and all the different avenues and asset classes and all this fun stuff. Of course, we're focused on the senior living side of things now, which is good to have some clarity. But it's just it is a fun journey. That's for sure. Well, I want to be respectful of your time. I wanted to ask if you could give one piece of advice to someone who's just getting started, who's listening to this podcast today. What would that be? And then I'd love for you to share how folks can connect with you.
Yeah, I think get started, buy that first property. And if you feel like you can't go by yourself, find partners, and it doesn't have to be in medicine. There's all walks of life that come with so many different skills, and they actually may just be right next to you and have the same exact interest and same passion for real estate. So I think finding that partner is just a huge accelerant.
I love that. That is great. And then if folks want to reach out to you and connect, is there a way they can do that?
Yeah. So it's Kathir Balakumaran on LinkedIn. So yeah, if you want to connect and ask for any questions about my journey, I'm happy to answer.
Awesome. Kathir, this has been great, man. Thank you so much for coming on the podcast tonight, for sharing your journey. Super exciting to see everything that you're doing. Excited to have you back on the podcast sometime soon and see where things have grown in scale over that time period. And so thank you so much for taking the time away from the family to do this, and really, really grateful for having you on the podcast tonight.
Thank you, Alex. I appreciate it. Thanks for the opportunity. It was a great talk.
Yeah. Absolutely. Well, with that, it's been Dr. Kathir Balakumaran and Dr. Alex Schlo with another episode of the Physicians and Properties Podcast. Signing off. Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only. It should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.